No new bad news is good news, to paraphrase the late, great Gary Gnu. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
You say that?
Yeah.
I say nothing burger.
Nothing burger.
That's what I'm going to say. That was a nothing burger PCE. I'm Alex Steele. We're kicking you off to the closing bell here in New York. And in my mind, you can kind of see that reflected within the equity market. The S&P just up 0.3%, but it does feel like what we learned is that you're going to want to sell the rumor, maybe buy the actual data. That's what we're kind of learning a little bit today in the equity market. Hormel Foods, though, moving on its own. At one point, rallying the most since March 2000. You had revenue and earnings had a nice beat as we trickle to the end of earnings season. A little bit, and I mean a little bit of a bid in the 10-year. It was a little bit of a bid pretty much all across the curve, but now the front end seeing a touch of selling. I gotta say, I think that's just positioning. And dollar yen, because it is Romaine's favorite, down by about 0.5%. You finally get this yen rally, Romaine, as we had an official talking about the fact that they're getting close to that inflation target. I know it bores you, but that would have huge implications for the Treasury market. Oh,
I'm excited. 149.95 down 0.7 there here. But let's talk about that big PCE inflation report, which, according to Alex, turned out not to be a big deal at all, a nothing burger, to steal her phrase. While we did see inflation rise, the increase was spot on what economists had expected. An in-line report that gave investors a bit more assurance that while Fed rate cuts might not be imminent, there's less likely a need for rate hikes, as many people had feared. Fed funds pricing on the Bloomberg terminal right now showing investors holding firm on estimates for the first downward shift in rates to come at the FOMC's meeting in mid-June. Now, that nothing burger of a PCE report, a fitting punctuation to the end of February, where the S&P, the Dow, the NASDAQ, the Philadelphia Semiconductor Index, even the Magnificent Seven, each logging 4 straight months of gains to reclaim record highs. Oil even got some of its mojo back this month, rallying 4%, and the coin called Bit posting its strongest monthly gain going back to December 2020. No coincidence that the best performing stock in February, at least among large caps, Coinbase, up 56% for its third best month ever as a public company. Discretionary stocks as a group up 8% this month. Industrials up 7%, materials up 6%. All told, more than 60% of the S&P 500 companies posted gains in the month of February, about 70% of the Russell 1000 in the green as well. As for the Russell 2000, the small caps, they have started outperforming again. The Russell on this Thursday poised for its strongest week of outperformance all year as it tries to gain lost ground to the Dow, S&P, and NASDAQ, which recouped their losses from that early 2022 sell-off. But the fact that Russell still remains, Alex, more than 15% below its all-time high set back in November of 2021.
Yeah, see, and that's why, maybe it's a nothing burger when we talk about broadening out. You like that phrase. Have you heard this phrase?
I'm tickled. I have heard it, but coming from you, it has an extra little bit of oomph to it.
He's tickled. Aw, that's cute.
I'm going to go over here.
Yeah, go do that. All right, here we go. We're looking at the Russell, the NASDAQ 100, and the S&P. No shocker, this is over the last year on a normalized basis. So I appreciate what Romaine's saying in terms of small caps outperforming in the short run. But this just goes to show just how far they are below the rally that we've seen in the NASDAQ 100 and the S&P. So this is NASDAQ 100, up 51% just in the past year. Remember, normalized basis, you got the S&P up 26% and the Russell 2000 up 8%. So what I want to know is, if we wind up getting stronger economy or economy that holds in, right? We saw consumer spending coming in just fine. If you have inflation eventually treading lower, we're going to get maybe 3 cuts and everything looks to be somewhat okay. What kind of outperformance are we going to see in the small caps? Or, Romaine, are we in the divergence, right? The large cap guys still doing well, but some of the underlying economy is not doing that well. And that's why we're seeing overall, on a relative basis, weakness in the small caps.
Absolutely. Here, maybe that changes, maybe it doesn't. Jill Carey Hall hopefully has some answers for us as we kick you off to the close. She's the U.S. equity strategist and head of U.S. small and mid-cap strategy at Bank of America Securities. And Jill, let's start there here. I mean, I was just going through, the stock market almanac and some of the other sort of historical narratives here. And typically you do seem to see more strength in small and mid caps coming off these narrow types of rallies that we saw for much of 2023.
That's right. And we're positive on small caps relative to large caps this year. I think, as you pointed out, the fact that the market was so narrow last year, typically in those instances, historically, you have seen the market broaden out after that. Small caps lead. We also like the equal weighted S&P 500 over the cap weighted S&P 500. I think, GDP growth, the fact that we're going to, based on our expectations of a soft landing rather than a recession that many were forecasting last year, is a positive. And even more so than GDP growth, I think just the profit cycle inflecting. We saw the worst of the negative year-over-year profits growth midway through last year. That started to improve for the last several quarters in both large and small caps. Small caps have actually seen a bigger beat so far this earnings season. So that profit cycle inflection is an environment when small caps typically lead.
When we talk about valuations, at least on a relative basis, so much talk about how overvalued, at least by historical measures, you're seeing in large caps and the NASDAQ and the S&P. When you look at the Russell or some of the other SMID and small cap indexes, do you see a better relative valuation there? Are they cheap?
Definitely. And the small cap index is really the only size segment of the market that is still historically cheap, still trading a little bit below the long-term average for the Russell 2000, about 14 times forward earnings when you compare that to large caps, which are trading at around 20 times above their historical average. So the relative multiple definitely argues for upside. Usually valuations are more predictive over the long run. So we certainly would expect that, if you have a 10-year time horizon, the annualized returns over the next 10 years for small caps are likely to be higher than for large caps based on just the valuation discrepancy today. But I think, the combination of valuation, the profit cycle inflection, even the macro indicators, when you look at the ISM, this is one of the most correlated macro indicators of small cap performance, starting to inflect. A lot of the leading indicators of manufacturing have started to inflect. I do think you want to be selective. The Russell 2000 obviously has problems as an index in that, a third of the companies are still non-profitable, non-earners, so to speak. So I think, this is a year where stock selection or investing based on themes makes sense. And we've seen sentiment start to turn around for small caps, but based on the investor flow data we've seen, it's largely been buying small cap ETFs so far, not necessarily buying small cap single stocks. So I think there's still more room to run from a sentiment perspective, and especially for stock picking. And obviously there are a lot of opportunities there.
Jill.
Via VA, we cover about 1,000 small and mid cap U.S. stocks.
Jill, is this setup different than what we saw, say, 5 months ago when small caps had a little moment?
Well, I think, the backdrop for some of the largest sectors in small caps has certainly gotten a bit better. Healthcare, for one, obviously biotech is a big weight in the index. That was a sector that had continuously been ranking very poorly in our work. Obviously, non-earners in this.
Yeah, sorry. I think we're having some issues with Jill's connection. Jill Carey Hall, U.S. equity strategist and head of U.S. small and mid-cap strategy over at Bank of America Securities. And Alex, she was making a good point here, because you talk about this idea of where value really is. And definitely on a historical basis, you can find it in small caps, but even in the here and now, on a fundamental basis, there's certainly an argument to be made that maybe this is finally that time where we see a fuller rotation.
Or is that a value trap?
Yeah.
Or how long does that wind up lasting? Remember we talked about the other day, was it yesterday?
Yeah.
Where you look at value versus growth within the small cap, and it's still growth, right? So that value trade within small caps still is not performing as well.
And I'm glad you used that phrase. That's a better phrase than nothing burger, because I feel like, what was it, a year and a half ago, we were having the same conversation about the breakout in the Russell, and of course, that did not stick at all. All right, our apologies to Jill Carey Hall. We love her there, and we'll get her back as soon as we can. But coming up here on the show, a closer look at some of the individual movers climbing on the day, and that includes Papa John's. Executives saying the pizza chain expects U.S. net new unit growth to increase by more than 20%. The CEO, Rob Lynch, joining us for an exclusive conversation.
Garlic sauce from Papa John's got me through college. All right, plus Best Buy shares jumping on improving sales, leading to some upgrades on the street. We're going to break it down in today's top calls. And shares of GoodRx actually getting a pretty decent rally here, finally starting to impress investors after a big management shakeup last year. We're going to sit down with the interim CEO, Scott Wagner, a little bit later in the program. Stick with us. All that and more coming up here on The Close. This is Bloomberg. All right, one stock we're watching right now is GoodRx. It's up about 22%, a big gap higher overnight after reported earnings that beat the street. Remember, they had an executive shakeup last year, and they are also trying to assure investors that a recent system outage at United Health shouldn't have a material impact on finances. Let's put all the stories together and talk to the interim CEO of GoodRx, Scott Wagner. Scott, It's great to see you. Let's just talk about the quarter that was. It looks like your forecast to return to revenue growth is evenly split between both of your businesses, whether you're looking at prescription businesses or the pharma manufacturing solutions business. What's changed in each of the businesses that was allowing that to happen?
Thanks, Alex. Yeah, what's nice, and the last quarter had 7% revenue growth. EBITDA was up 15%, and those results are coming from really us doing three things. One of which is marrying up to our retail pharmacy partners, Walmart, Walgreens, CVS, to help them merchandise the cash discount category. The second is a program we're doing with pharmacy benefit managers and insurance companies called Integrated Savings, which basically takes your insurance card and marries it to GoodRx so that when you're using it, you get the lowest price of either. And the final is in pharma manufacturing solutions, our effort to bring savings value on brand drugs with brand manufacturers. And the nice thing is, all those three things are working and showing progress, and it's showing up in the results.
What's not working? Like, what are some of the hurdles that you still have to? You shook your head at that. You're like, nothing. Everything's working. It's fantastic. I'm interim CEO. But what are the things that are still glitchy that you got to kind of work out?
I was smiling there thinking on each of those things. In healthcare, you have to work with other parts of the system, whether they're retailers, insurance companies, benefit managers, drug companies. And a lot of these things involve a couple of people working together. And there's usually in healthcare a lot of arm wrestling around who benefits from what. And a lot of what we're really trying to do is make sure that if we're adding value to people, to patients, which is really GoodRx's mission, that you do that first, you create a savings benefit for somebody, and then on the back end, split up the dollars so that everybody gets some and everybody wins.
There's been a lot of discussion here now about this idea of a rebound, not just in the shares, but the idea of putting this company back on a path to material growth here. When we talk about the bottom line, and whether we're talking about GAAP or EBITDA or whatever metric you guys choose to embrace here, when do we start to see that, I guess, get back to a level that's going to support much more upside here for investors?
Yeah, thanks. I think we're in a nice spot. So we guided, in the coming year to $800 million of revenue and $250 million of EBITDA. And that EBITDA margin is pretty close to 30%. So GoodRx as a business makes money, makes quite a bit of money, converts to cash nicely. And in our results, you're seeing nice growth, not only in margin, but obviously as revenue grows, it flows through the. So we're having a nice trajectory.
But how do you protect that as well, Scott? I mean, we've interviewed your predecessor several times, and I'll ask you the same question I asked him, I think, every time he's been on here is, how do you deal with the competition from, a behemoth like an Amazon or a behemoth like some of the other pharmacy benefit managers here? How do you address that?
I think the biggest thing is to focus on 25 million people a year that use GoodRx and the 15 billion of savings value we created for them. As long as we keep saving people money on prescriptions, we're going to be in great shape. And I think that stacks up nicely relative to Amazon's and relative to the system, whether they're pharmacy benefit managers or retailers. Those are really partners for us.
Just a broader scope here. We talk all the time about the weight loss drugs and stuff. What do you think is going to happen with them? Like, do you think the insurance companies are going to cover them? Do you think the demand's going to be as great as it is when the CEOs are talking about it? What's your visibility right now?
That's an awesome question. So here's what I think is going to happen. So it is very clear right now that every weight loss drug is flying off the shelf. And the biggest thing in the market is a supply question around, boy, there's a heck of a lot of demand for people for all of these drugs. It's obviously a very nice part of our business as people are looking for them as well. I think if we look forward over the next couple of years, you are going to see a lot of different formularies, both brand, generic, all addressing the same proposition. And some of them are going to be covered through insurance and some won't. And that's a really nice opportunity for us at GoodRx, particularly for those kind of instances where people are, it's not covered by insurance. You're paying a crash price. You really want it. And GoodRx is in this unique position, and this is what we're working with the manufacturers on, to put a real price that somebody would want to pay against it. And that's the things that I think not only we're working on, but are the big opportunity over the next couple of years.
Hey, Scott, really appreciate you taking time for us. Scott Wagner there, interim CEO over.
Thanks for having me.
Absolutely, over at Good RX. Alex, he loves your questions.
It wasn't mine, it was Aviel.
Yeah.
It was our producer. Credit where it's due, man. I was going to ask about CVS and their cost advantage plan. Hers is way more interesting.
Yeah, it was way more. And actually, I'm glad you asked that because it does get to this idea. I mean, particularly the whole point of Good RX was the idea of offering consumers something that was more affordable than what they were going to get from the traditional pharmacy benefit companies. And they did that for a while, and they sort of ran into some hiccups with that. And whether they can sort of have the negotiating power and, more importantly, the leadership to actually do it, that's a big question here, I think, for the stock.
Yeah, and also just the transparency. Like, who would have thought you'd have transparency on drug pricing?
Yeah.
Like, that feels a little unheard of, no?
Yeah, don't worry, Alex. I'm sure corporate America will get right on that. All right, coming up here, we're going to focus in on another big corporation out there, Best Buy. Sales slipping in the fourth quarter, but that isn't stopping Best Buy from taking a more optimistic view towards demand. We're going to recap the results and tell you what Best Buy sees is next. This is The Close on Bloomberg. Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off with the chaos over at Cummers. The maker of refrigerants, resins, specialty chemicals, double downgraded to underperform over at BMO. The analyst saying the risks to the bottom line heightened by that suspension of the CEO, the CFO, and the principal accounting officer amid a delayed earnings report as the board continues to review the company's past accounting. The price target more than halved from $45 to a street low $19 a share. Those shares moving down by 29% today, the worst day on record. Next in line, let's take a look at Beyond Meat because they did get an upgrade. This over at Argus Research to hold, with the analysts encouraged by the shifting focus to profitable core products and an emphasis on controlling costs. A little sun, little water, and well, they see earnings growth in the plant-based meat companies' future looking brighter. The shares, which rallied more than 30% yesterday, up about 16% today. And let's take a look at Okta. The strong fourth quarter results at the application software company, and that led to a double upgrade to buy from underperform. This over at Bank of America with the analyst Madeline Brooks saying her concern around consumer growth and execution, that's all gone away. She adds Okta's fiscal guidance just the right amount of conservative while leaving room for upward revisions. Those shares having a pretty decent day, if I say, up about 22%, and those are some of our top calls. All right, let's pivot over to Best Buy. There's been a lot of focus here on this company and on this stock coming out of the holiday season, gaining newfound optimism on the state of the consumer as same-store sales in the fourth quarter did beat estimates and did show signs that maybe there is a pathway for longer-term improvement. Anthony Chicumbo joining us right now, senior research analyst at Loop Capital Markets. He has a buy rating on Best Buy. Anthony, were you encouraged by what you heard?
I was encouraged. I was encouraged by a few different things. First off, fourth quarter results did come in a bit ahead of our expectations, particularly in terms of earnings. They were 20 cents ahead of consensus, about 8 cents ahead of consensus. So that was encouraging. Operating margin actually did improve year over year. That was driven by gross margin expansion. Second off, we were encouraged by the 2024 guidance. I think that there's some concerns that the guidance was going to be weak, but it was pretty much in line with consensus. As you said, management did point out some reasons for optimism in terms of consumer electronics demand in 2024.
So when you look at sort of what I guess Corey Berry was handed when she was took over as CEO, obviously there was a growth story here that needed to be reestablished on the top line. When it comes to longer term profitability here, is there an opportunity here to really expand margins, or are we just going to have to get used to the sort of the narrower margins that have occurred over the last few quarters?
Well, one thing I would say is that consumer electronics intrinsically just don't have particularly high margins. So, you're never going to see this company have like a double-digit operating margin. Having said that, I think that there is some reason for optimism that margins can grow over time. I mean, they're keeping their operating margin about 4% with very, very difficult top-line trends. If we are to see, better top-line trends, then you would get some leverage on your fixed costs. And I think that would lead to gross margin expansion. And the one thing that we are seeing operating margin expansion. The one thing that we are seeing, like I said, that's been encouraging in 2023, which is expected to continue to 2024, is a little bit of gross margin expansion. But yeah, we're never going to see this company have a double-digit operating margin.
I got to be honest, I don't think I've been in a Best Buy I don't know, 8 years, I think, Anthony. I mean, not that I'm a barometer for Best Buy, but I'm just saying, like, I don't even know where the Best Buy stores are anymore. And Anthony, I'm just wondering how they're doing with e-commerce, for example. How are they doing in competing with Amazon? Or is the fact that they do have physical footprints and they do have their IT department, like, is that their winning factor?
So look, I mean, you haven't been in a Best Buy in quite some time, but chances are you've probably shopped at BestBuy.com. I mean, one of the nice things about Best Buy is they are a great omni-channel retailer. They have very aggressively invested in their e-commerce over the last several years, and so the pricing is pretty much in line with Amazon. We do quarterly pricing studies, so we're very certain of that. In addition, there is that advantage of having the stores, right? Like, so one thing that Best Buy mentioned is that 44% of their online orders were picked up in store. You obviously can't do that, within Amazon. And just because there has been that shift from brick and mortar to online, they have been, very intentionally rationalizing their store base. So to some extent, it's kind of the best of both worlds.
Is there any product super cycle, Anthony, that would really put Best Buy out there and give them a nice little upgrade cycle?
So there's not much that we're seeing. I mean, there's definitely talk about these, sort of AI PCs that will be coming out, but it's unclear to me, whether that's just kind of like a marketing gimmick. Samsung has some new smartphones that have some AI capabilities. Those seem to be selling pretty well. Look, I think what we're sort of waiting for with Best Buy is the macroeconomic environment to improve, particularly, existing home sales, which would help their appliance business as well as their TV business. And then also there is this sort of natural replacement cycle. They're certainly hoping that a lot of products that were purchased during the throes of the pandemic are, sort of kind of petering out and are ready to be replaced.
All right, Anthony, thanks a lot. Super appreciate it. Anthony Chukumba joining us over at Loop Capital Markets. To be honest, I haven't gone to BestBuy.com recently either. But that's just me. I feel like I'm an anomaly for sure.
I'm curious about the omnichannel side because I think the last time I went there, I tried to do, it was during the pandemic, I tried to do where you buy online and then pick up in the store, and the pickup process was a mess, to say the least. Yeah, it was to the point where I should have just ordered this off Amazon. Now, in fairness to them, that was 2.5 years ago, so maybe it's improved, but that's a big part. You just can't say we're omnichannel. You have to have the sort of the lack of friction to make it.
Which is why Target does really well with that. You buy online, you pick up, you buy more stuff. Like, that's the whole point. You do that with electronics. I would do that with garlic sauce from Papa John's. They're popping right now on some growth plans. CEO Rob Lynch joins us next. This is Bloomberg.
Just about 3:30 p.m. here in a beautiful New York City. This is the countdown to the close. I'm Romaine Bostick. Happy leap year, Alex Seal.
Happy leap year.
Yeah, I know.
I read a story.
This is the only time we can say this for the next 4 years.
It's true, but I read a story that a woman who was born on a leap year, her mother would only let her have a birthday party every 4 years on her actual birthday. And she's like 80 now, so she's only had like 4 birthday parties.
That's really sad.
Or something like that.
4? Okay. You weren't a math major at Northwestern.
Back of the envelope calculations, maybe a little bit more than 4. Point being is that kind of stinks. What also I've been calling a nothing burger is what happened with core PCE today. So it rose at its fastest pace in nearly a year last month. We've had the opportunity to check in with leaders though across the restaurant business to just get an idea on the ground of what's happening with their input prices.
Inflation. You look at inflation from 2020 to now, we almost up 20%, so the prices change. I used to be able to build a location around $500,000, now it costs me $750,000, upwards to $800,000.
On the COGS side, we've seen pretty benign inflationary pressures.
Throughout 2023 and into 2024, our guest at all 3 of our brands has been remarkably resilient to the extent that it really surprised us a bit.
Let's get the take now from Papa John's. CEO Rob Lynch joins us now. Shares are up today after their results beat analyst estimates. You got the pizza chain experiencing a net new unit growth in the year to increase more than 20% relative to 2023. We're off the highs, but nonetheless, it's still up over 2%. Hey, Rob, let's just kick it off with the inflation part. Where are your inputs rising? Where are they stable? Where are they falling?
So 2022 was a really tough year for us. We saw about 15% food cost inflation, and 15% labor inflation. And in 2023, that leveled off, and we actually saw a little bit of deflation year over year. So as we head into 2024, we're looking for a modest increase, more consistent with what we've seen traditionally in that, call it 2 to 3% range, both on the commodity side, maybe a little bit higher on the wages, but that 2 to 3% range is kind of what we're looking at in 24.
And do you feel like you're in a good place to manage that in terms of margins? Like, do you have to pass on price increases, or has that kind of peaked out? What do you do on the consumer side?
Yeah, we've taken a lot less pricing than maybe a lot of other segments of QSR. And I would say that pizza at this point is probably at a better value ratio to the rest of the restaurant industry than we've ever been in. So we do have a little bit of pricing power to cover the cost, but we're not using pricing to drive our comp sales or really increase our margins. We're really looking at continuing to drive transactions, grow our customer base and our organic channels as well as our third-party channels. And so we really try to take only enough pricing to cover the cost increases.
I am curious about that flow of transactions and where it's coming from, Rob. I mean, what's kind of the breakdown of how much is coming directly through Papa John's and how much is coming through the third-party apps and sellers?
Yeah, we love our organic business. We have a great loyalty program. We've grown our loyalty membership from 12 million to over 32 million in the last 4 years. So we've got great, loyal, frequent customers. But we've also been able to increase our business very dramatically through our partnerships with the third-party aggregators. We were one of the first national pizza brands to partner with all the large aggregators. And so we've honed that model over the last 5 years. And, we reported today that our business in the fourth quarter actually was up 50% year over year with the aggregators. So that channel, although smaller than our organic business, is growing rapidly.
And the cost to Papa John's, is there something you sacrifice in terms of margins when you're getting an order through the third party as opposed to directly through Papa?
No, we've been able to, that channel has been relatively incremental for us. And so we're seeing incremental profitability on an absolute basis. The margins are relatively consistent. So it's been a profitable growth model for us.
I just want to turn to your businesses within the Middle East. So 20% of your international store base is in the Middle East. What has been the result of the conflict between Israel and Hamas?
It's a challenging environment for everyone. Over the last 5 years, we've really focused at Papa John's on being a super inclusive organization where everyone can show up and bring their best self to work every day. And so, as we look at that conflict and some of that division, we have franchisees everywhere, franchisees on both sides of the fence, and we're trying to be good partners for everyone and support them during these challenging times.
But is it impacting expansion plans or less willingness of your franchisees to build new stores, et cetera?
Yeah, we have had a really great run across that region for the last few years. And we have some of our best franchisees in the world operating in the Middle East. And so they still have a strong appetite to grow. They have great plans and lots of capital to get that done. But over 2024, there is a little bit of a modest wait and see situation where they're trying to see how things are going to shake out in the region.
And real quickly, though, Rob, I am curious, when you're looking at long-term expansion here, do you see that expansion coming outside of North America, particularly in the Middle East or maybe in other parts of the world?
Yeah, absolutely. We are really focused on taking advantage of the white space that we have in North America. We have about 3,600 units relative to, our other competitors that are about 2x. So we have a lot more room to go out there and build restaurants in North America, and that's where it's our most profitable and biggest, market. So we're definitely focused domestically, but a lot of the long-term growth is going to come internationally. We operate in 50 countries, and we've had a great run over the last few years, and we're almost to a point where we're going to have 6,000 Papa John's globally, and yet we haven't penetrated some of the largest markets out there. So we have not yet opened up in Japan or Australia or Brazil or South Africa. So there's a lot of room for us to continue to go out there and take advantage of that white space.
Rob, before we let you go, weight loss drugs, all the rage. Are you worried, or are you seeing any impact?
Yeah, I mean, we don't attribute any impact to our business today. I think pizza is a fun food that brings people together around social occasions. It's not something that, we're super concerned that people are going to scale back. I mean, we're birthday parties, Super Bowl. It's kind of a special occasion, Friday night feel good. Let go of maybe some of the discipline you had at lunchtime during the week. So I don't think it's going to impact us as much as maybe some other categories.
All right, Rob Lynch, CEO there of Papa John's. A closer look here at the shares. PZDA up slightly here on the day. I want to bring you some breaking news. This involving Kodak, of course, the former photography company, now a chemical company, a company decimated for years by underfunded pensions, now getting a big break from an overfunded pension. The shares rising 40% on the back of news here that the company not only has a surplus in its pension plan, but plans to tap that surplus more than $1 billion. This according to people with knowledge of the matter. Bloomberg had reported yesterday that Kodak was planning to jettison that pension fund off to a third party here because it was finally overfunded. Now learning, based on Bloomberg reporting, that they're going to take about $1.2 billion out of that surplus for themselves. All right, coming up here, we're going to take a closer look at another big mover on the day, Xcel Energy, under pressure after a law firm claims that that company may be linked to the wildfires that we've been talking about down in Texas. That's our stock of the hour. It's coming up next, right here on The Close. This is Bloomberg.
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
All right, it's time now for our stock of the hour. We're going to take a closer look at Xcel Energy and a closer look at the wildfires burning right now in the state of Texas. It is the largest ever wildfire in Texas's history. More than 1 million acres now in the state's panhandle said to have been burned. And we did learn in a regulatory filing from Xcel Energy late yesterday that a group of insurers who have apparently contacted a law firm are now claiming that some of the property damage as a result of these wildfires, in their words, could be linked to Xcel and some of its power lines. Abigail Doolittle joining us right now for a little bit more on this. You see the shares moving lower here on the day. What more do we know about this?
Well, they are certainly moving lower on the day, but they are off the lows. And the initial reaction to any of these wildfire fires that happen to do with utilities is one of fear and uncertainty. So you see the stock plunge. Now, relative to PG&E, that stock is still down about 75%. So this is relatively small in comparison. But to your point, these fires are absolutely tragic, the largest in Texas history. For those viewers who have not are just tuning in now, the agricultural commissioner down there saying you can't describe how bad it is, that for some ranches that are 100 years old, everything is gone. Tens of thousands of cattle have burned, wiping out ranches. One person has died. So really, really bad. Dry conditions. It's being called the Smokehouse Creek Fire, and it has expanded 20-fold in 2 days. Now, relative to Xcel Energy and to what you were saying, a law firm, an unnamed law firm representing some of these property owners, has told Xcel to save a fallen utility pole, that it could be the cause of the fire. Now, this is all, we don't know. This is, I don't want to call it speculation. It sounds like a little more than speculation.
And we should point out, this came from Xcel.
Xcel
as
in a
risk
filing.
Disclosure.
Yes, as a disclosure.
Which they would be regulatorily required.
Yes, and that's where this reaction is coming out of.
But I do have to say, I mean, utilities triggering wildfires is obviously not at all unprecedented, right? PG&E eventually became responsible for the worst fire in California's history. You have Hawaiian Electric is also the target of a lot of lawsuits, blaming half the Maui fire of 2023 on the power lines. it's really hard to update these power lines. And the question becomes, what do you do with these power lines? If you put them underground, that's going to cost a ton of money to do that.
Yeah.
They have to get approval from the government. Then they have to get approval to raise prices on people so they can afford to pay for that.
Yeah.
That feels like that's not going to happen.
Yeah, that's a major infrastructure change. And we should mention also that Xcel itself is involved in lawsuits from 2021 in a Colorado wildfire. Apparently high winds snapped a utility wire, and they're being blamed for it. Xcel, of course, is saying that they're not responsible for that. Some analysts are saying that this type of a reaction for utilities, it's a relatively new risk with climate change and the litigation that we did have from PG&E creating the precedent relative to the stock put demand surge, 16,000 contracts. It's interesting. The long-term uptrend for this stock has snapped, and it caused me to look at the utilities overall, not having so much to do with this, but because of rates rising, utilities themselves may in fact be breaking down. So lots of interesting factors here.
All right, Abigail, thank you so much. We really appreciate it. We just want to get some breaking news here. Loretta Mester is speaking to Yahoo Finance and saying some interesting things, really gelling with the rest of the Fed. She says 3 cuts this year feels about right. She says that you can't rely on inflation falling as fast as last year, and the PCE inflation does show that the Fed has a lot more work to do. So not done yet, kind of doubling down on what other Fed officials are saying after that PCE data came in this morning. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele with about 10 minutes to go into the closing bells. Alex, what has been catching your eye all day long today?
Well, a couple things. One, the rally that we've seen, right? So record highs for the S&P, the NASDAQ, you name it.
Not a nothing burger.
Okay, I guess. A reluctant non-nothing burger. How about that? But this month has been tremendous.
Yeah.
I mean, we've seen the S&P best month since November, the NASDAQ 100 rising for 4 straight months, longest winning streak since July. Russell 2000, best month since March 2022.
Yeah.
2-year yield up 43 basis points in the month. I mean, this is a solid performance.
And remember, on a historical basis, February is supposed to basically be the worst month for U.S. stocks.
But apparently leap days are supposedly be good.
Leap days, is that the exception? So every 4 years?
Just the day.
Reset? Okay, all right. Well, there you go. Well, February has been a great month for stocks, whether that's because of leap day or not. I don't think it really matters, right? People made money, and we got a chance to catch up with Jill Carey Hall over at Bank of America Securities about, well, whether the market is actually overstretched.
There's still more room to run from a sentiment perspective, and especially for stock picking. And obviously, there are a lot of opportunities there.
Jill.
B of A, we cover about 1,000 small and mid-cap U.S. stocks.
Jill Carey Hall there, who joined us to kick us off to the close just a little while ago. And here to help take us to the closing bell is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. And what a month it's been, Nancy. I mean, it's a phenomenal gains here. And I think the thing that impressed me the most was that we actually finally started to see a bit of a rotation away from just the big cap names into, I guess, just a broader array of names. And as part of that rotation, I was taking a look at the best ideas portfolio you guys have there for Laffer Tengler, and I've seen some rotation there as well.
Yeah, absolutely. I mean, I think, well, that's what you have to do as a portfolio manager. You're always in a perpetual state of dissatisfaction because you can't even enjoy your wins. You have to move on to, now where do I need to be positioned? But I think there's a lot of reasons to be optimistic. That said, I hope sooner or later we get a correction because we need one to kind of pare things back. And corrections are always healthy. We get about a 10% correction once every 12 months. So I wouldn't be disturbed by that. I would use it as an opportunity to add to high quality names that you've wanted to own.
Do you think, though, as far as getting that correction here, Nancy, I mean, sort of what, I guess, would even prompt that? I mean, would it be something that would be, I guess, just so existential for the market that it might actually be overdone? Or do you think we can get something a little more orderly?
I think it can be more orderly, Romaine. I mean, if you think about what the catalyst would be in the next few weeks, earnings are pretty much done. And it was a great earnings season, the fourth quarter. And so I think it would be some other event or back to Fed speak, although, today's numbers and the comments that Alex just shared about Loretta Mester, saying, yeah, I think it's 3. The market's now kind of saying, I think it's June. And that's why the 10-year rallied a little bit today. So, but I think it's just lack of great news that could just, kind of deter investors. Remember, there's a ton of money on the sidelines, But we also know that companies are poised to do a significant amount of share buybacks. And so I think, that could just keep us in a sort of narrow trading range.
Nancy, then what's on your shopping list if we get some kind of pullback? And by pullback, I mean like this kind of pullback. I don't really feel like we're going to get the real correction we're all waiting for.
Well, there's names that we want to own. We just initiated a position not too awfully long ago in CrowdStrike, and that's one I'd like to buy more of at cheaper prices. We also are probably the only money manager on the planet that doesn't own NVIDIA. It was in our buy range briefly. I think I went and got a cup of coffee and missed it. Yeah. And so, we want to be able to take advantage of some of the names that we think will sustain growth. But that said, you can generate pretty fantastic returns even without NVIDIA in your portfolio. So don't chase these things, let them settle, and then move in later.
Would the solution just to be buying the index?
Well, it could be, but that's, we're large cap value and growth at a reasonable price manager. So our charge is to generate excess returns above the index and do it with less volatility. And we've been able to do that over the long term. Yeah. But yeah, that is certainly a solution.
Yeah,
sure.
Yeah, I chuckled at the NVIDIA question, Nancy. I mean, we were talking the other day. Kathy Wood, of course, also missed that trade as well. So you're in good company, so don't feel too bad. She's doing okay, and I'm sure you will too. And one of the reasons why we love you too is you're not just one of these people that sits around the office all day. You do get out there and really put boots on the ground. And I was told that you had a chance recently to tour Tesla's battery factory recently. And as everyone knows, Nancy, everyone's concerned about this slump in EV demand. Everyone's concerned about whether Tesla stock has kind of seen its peak forever. What did you see at that battery plant? Did it give you any sort of hope that maybe we could see a nice rebound here?
Absolutely. So the mega battery is what they sell to electric utilities around the globe. It's the fastest growing division at Tesla and the most profitable. So when you hear people talk about the slowdown in EVs, as you just pointed out, that is part of the story. That's the intellectual kind of mind share surrounding Tesla. But what really struck me was two things. One, this is a great country. That factory was a JCPenney warehouse. Mm-hmm. And in less than a year, they turned it into this mega factory that is I can't even explain some of the things that they described to us, but it's so interesting. They've doubled the number of workers to 1,700 in the last year alone. And the culture, I mean, I drove into the parking lot and people were jumping out of, behind cars trying to help me. The culture in the factory was really upbeat and positive. I came away very encouraged, and we're going to be adding more to our Tesla holdings. We did recently on the sell-off, and we'll continue to do so.
Do you think, though, we'll ever see, I guess, a material competitor to Tesla in this space? And I don't mean just necessarily just in terms of selling EVs themselves, but really kind of this whole ecosystem that Musk has built.
Well, I think we will. They think they have a lot of competitors, and they would cite, the Chinese EV makers in that segment of their business. But I think what he realized was that vertically integrating makes it a lot easier for their customers. And, Alex, you were talking about the PG&E fires and the other fires. I live in Incline Village, Lake Tahoe most of the year, and we get penalized from those fires. And it's because they don't do forest management. And so the wires are hooked up into trees. This is going to be a solution when you can store power in these giant battery packs and pump all night long when the solar power isn't doing the trick for you.
All right, Nancy, always love talking to you. Nancy Tengler there, CEO and CIO at Laffer Tengler Investments, helping us count down to these closing bells. Just about 3 minutes to go here, Alex. And she kind of gave you a shout out on the power plant thing, which I do think is interesting to see whether this does become a much broader issue. I mean, we kind of know it's a broader issue, but is it going to be actually addressed?
I mean, I just don't know how you do that in a cost-effective manner, and that's sort of the problem with the regulation part of it too, right? And even if you don't put it under the ground, you have to go and replace all the poles. I mean, how do you do that in a way that winds up making sense?
Yeah, and I raised that too. We had some breaking news while she was talking, the Biden administration and an EPA rule for power plants that everybody was expecting. Apparently that rule is now going to be narrowed down. This was primarily surrounding greenhouse gas emissions.
Right, because it's not green and it's not bad. It's just blue. It's all gray. Everything's gray. We got to work on gray.
All right, a full breakdown here at month end as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. Joined now by Scarlet Fu here in Studio 2, Carol Massar, Tim Stenovic, helming our radio studio as we welcome our audiences across our multitude of Bloomberg platforms. Happy Leap Day, Carol and Tim, and a happy day in the markets.
Yeah, absolutely. Like, great, right? The inflation report coming in just as expected, didn't come in hotter, so I think everybody's like, whew. I will say one of the sectors that I've been focusing on is the semiconductor sector because it's definitely outperforming, guys. 2.8% to the upside. You've got all 30 names in the stocks trending higher, and this is thanks to Citi, which was out with an upbeat report and talking about a lot of names, some of it because of AI, and that's going to be good for semiconductor companies. But, man, outperformance there, Tim.
Why is Bitcoin up again? That's what I want to know. Up 2.7%. Today, Scarlett. It's the highest it's been since November of 2021, so we keep going back to those superlatives more than 2 years ago. We had Zeke Fox on the program talking about the, scamming, pig butchering, and he wrote number go up, so we had to ask him about why number keeps going up for Bitcoin. Yeah. He reminded us it's not just Bitcoin. A lot of other cryptos are moving higher too.
You know why?
And he didn't have an answer. He did not have an answer as to why.
Momentum.
Yeah.
You don't really have to have an answer beyond it's
Yeah.
up because it keeps going up
Just
and other people
because,
expect
right?
it to go up.
Yeah, absolutely. And then there's just the whole supply-demand dynamics as well, particularly with that halving coming up and all these ETFs that are basically scrambling over like 5 crumbs on the table to see who can get it into their ETF before the price goes up to like a gazillion dollars there. Anyway, a pretty decent day in the markets. Definitely a really great month here in the markets as we get the closing bells here on this Thursday afternoon. Let's walk you through the numbers, and there are some big numbers indeed here. We start off with the Dow Jones Industrial Average, which is going to finish the day in the green, only fractionally, up about 0.1%, but it is going to close out the month up about 2%. The S&P 500 up 0.5% on the day, 26 points, right around that 5,100 mark, capping what's going to be about a 5% gain here in the month of February. The NASDAQ Composite up about 0.9%, up 6% here on a monthly basis, and the Russell 2000 outperforming here, or outperforming most of the other major indices here, up 0.7% on the day and about 5.5% on the month.
All right, to the S&P 500 we go. Most names, or a majority of the names, I should say, higher in today's trade. 314, Scarlett, to be exact. To the downside, 185 for unchanged.
All right, let's take a look at the sector performances and the traditional sectors, the ones in which big tech are represented, are doing the best here. You've got communication services, infotech, and consumer discretionary, each gaining at least 0.9%. Your weak links are healthcare, consumer staples, and financials, but that's an awful lot of green there.
Yeah, exactly. All right, let's get to it in terms of some of the individual gainers. Or do we want to do Autodesk, guys? What do you want to do?
Autodesk.
All right, let's do the Autodesk. Okay, fourth quarter adjusted operating margin, 36%, a little bit better than what the street was expecting. 35.9% was the forecast, so coming in at 36%. Fourth quarter net revenue, $1.47 billion. That, too, a little bit better than the forecast of $1.43 billion. First quarter revenue. Outlook. This is what we care about. $1.39 billion to $1.40 billion. The estimate was $1.39, so maybe Scarlett upping it a little bit. And let's go back to fourth quarter adjusted EPS, $2.09 a share, folks. That's a beat. That's 14 cents better than what the street was expecting. And one more for the outlook. First quarter adjusted EPS, here's the range, $1.73 to $1.78. That looks like it's lowering it. The street right now at $1.78, but Scarlett, the stock is up almost 6% here in the aftermarket.
And it's doing so without a headline about a share buyback or a dividend. I almost expected to find something like that.
Okay, but there is stuff in here about AI, we should note. The company's president and CEO is saying that that Autodesk has led the industry in generative design, and they're leading again when it comes to 3D generative AI. They've got a new multimodal foundation model that's going to enable design and make help customers automate low-value and repetitive tasks and generate more high-value, complex designs more rapidly and with much greater consistency.
Yeah, and this gets to this idea, too, and you have NetApp also moving. This idea here of kind of the tale of two cities with a lot of these application and enterprise software names here, this idea here that, some are definitely going to do well because they already have that moat around them, but those others that we talked about yesterday, which don't have that moat, not doing well at all.
All right, on the flip side, you got B. Riley cutting its quarterly dividend to 50 cents a share. That's from $1. That stock is down by 19% after cutting that quarterly dividend. They also hire Moelis to review some options, and they're delaying their annual report on form for their 10K. So I think you put those together, that doesn't look very good for B. Riley. Cutting their dividend, looking at options, and delaying their annual report.
And this all goes back to that prophecy asset management collapse back in 2020 here, and they've really never been able to get out from under that. This looks bad, guys.
All right, so let's go back as we continue to monitor any new earnings come out. We'll bring them to you as soon as they are known. Let's get to some of the individual gainers. Among those top in the S&P 500 and the NASDAQ, I talked about the Citi call, very upbeat call on the semiconductor sector. AMD was number one gainer in the NASDAQ 100, and it was the number 3 gainer in the S&P 500. What Citi said is it continues to see strong prospects for the sector given tailwinds like artificial intelligence. Surprise, everyone. So AMD, we definitely saw that one higher in today's trade. You can see it up, about 9% here in the session. I'm going to go from high tech to low tech. Hormel, number one in the S&P 500, posting its biggest intraday since I think about May of 2000. The meat producer reported its biggest earnings per share beat in 10 years, everyone. So since at least the second quarter of 2013, according to our data, company also reaffirming its guidance. So that stock up almost 15%. And then Monster Beverage, a top gainer among the NASDAQ 100. That one also moving to the upside, up more than 5% here. The company coming out, fourth quarter gross margin beat consensus estimates. Analysts saw the results as solid overall, highlighting that gross margin beat in the quarter, as well as a strong start to the first quarter. So investors moving into those names pretty aggressively, Tim.
Okay, let's look at what happened at the other side of things with the decliners of the day today. Starting with Xcel Energy on the downside, more than 8.6%. This over the worst ever Texas wildfire helped send shares plunging because a law firm said that it might be linked to the disaster. It's the latest sign that potential ties between power companies and blazes are triggering volatility in utility stocks. Xcel did say in a filing that it's working with emergency response personnel to provide assistance. And then Chemours stock plunging to its worst sell-off on record after the company suspended its top 2 executives and put off reporting its fourth quarter results for the second time this month. Shares finishing the day remain down by 31%.
Yeah, a wild story there. More earnings, though, crossing the wire. Let's get right to it. This involving Hewlett-Packard Enterprises, HPE. First quarter net revenue, $6.76 billion. The street was looking for 7.1. A miss on the top line. As far as the bottom line, a modest beat here at 48 cents a share on an adjusted EPS basis. The street was looking for 45. The guidance for the second quarter, not looking a whole lot different. It looks like it's going to be light, 36 cents to 41 cents. Streets was looking for 45 cents on average here. And the full year adjusted EPS estimate also coming in, at least on the top end of that range, below what the street was looking for on average.
All right, and you can see Hewlett-Packard shares down about 1.6% at the moment, extending those declines. There's another set of results out from Zscaler. This is a cybersecurity software company, and it was a beat and raise quarter for Zscaler. Second quarter revenue, fiscal second quarter revenue, $525 million. Analysts were looking for about $508 million. Zscaler's adjusted EPS of 76 cents tops the average analyst estimates, which was 58 cents, and it sees third quarter revenue of $534 million to $536. When analysts were looking for somewhere in the range of 532.
Well, I'm looking at shares at Dell right now that are shooting higher in the after hours, up by more than 10%. This after the company boosted its quarterly dividend to 44.5 cents per share from 37 cents per share. Estimates were for 41 cents a share. Fourth quarter adjusted net revenue coming in above estimates at $22.32 billion, beating estimates of $22.14 billion. Shares higher by 7.8%.
And I just want to say, just looking at some of the commentary from both of those companies and also from HPE, we're seeing like commentaries about AI and the significance of it. So that continues. Quick check on something that's, again, low tech. Sweet Green coming out and giving some forecasts. Sees 2024 adjusted EBITDA of $8 million to $15 million. The estimate out there is 9.2. 2024 revenue, $655 million to $670 million. The estimate is $663.5 million. Always key. First quarter same store sales. So we're getting some outlook about 3%. The estimate was 2.34%. So that's better than forecast. And just quick looking backwards, fourth quarter revenue a little bit better than forecast, $153 million, and fourth quarter loss per share 24 cents, and the estimate was for a loss of 23 cents, Alex. So a little bit to the downside on that one. But Sweet Green, people may be liking that outlook. I'm about 7.6%.
I was actually going to order Sweet Green today. I even went so far all the way to the order page.
Me too.
And then when I saw the final price, I was like, eh.
Yeah, but that's, I had the exact same experience, and I paid $26 for a salad. It was not from Sweet Greens, but I realized it was the delivery and stuff. I got to get my butt outside. I haven't ordered in food for like 5 years, and this is the first time that I've done it. But I'm telling you, Ozempic effect, man. The weight loss drug is going to help these guys.
I love me some sweet green. That's all I'm going to say. All right.
Really? Are you going to buy some from us tomorrow?
For
I mean, it is Friday.
$26 a salad.
Sweet green for everyone, Carol? Is that what I heard?
A little static on the line. I can't hear you guys right now. All right, guys, that's a wrap. Some earnings after the close will continue, of course, on both sides to cover it. That's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. We will see you again beyond the bell, same time, same place tomorrow.
And some breaking news here, this involving the regional banks, New York Community Bank to be specific. The current CEO stepping down, a new CEO coming in. The headline is that Alessandro Danello has been named president and CEO of New York Community Bank Corp. The current CEO has stepped down. No reason given explicitly here for the change, but we'll try to get you some more details coming up here after the break on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bostick. We had this highly anticipated PCE report that did drop today, and it did absolutely nothing in terms of changing the tone of the market. Not really much of a game changer at all. You can see a lot of green on the screen here with the S&P 500 closing at a new record high, the first since last week. So far this month, it's gained 5.2%, and so far this year, it's gained about 6.8%. The Russell 2000 small caps outperforming the big caps, though they are laggards for the year, up only about 1.4%. Treasuries moved mostly higher, but very marginal moves here. And of course, the PCE data match economist estimates, so there wasn't a whole lot to react to. But Bitcoin seems to be the most exciting story in the financial markets, with the price, of course, continuing to power higher. And of course, that's the big story when it comes to the ETFs as well, because a lot of the gains are being credited to massive net inflows into those spot Bitcoin ETFs. You have turnover in Bitcoin ETFs reaching $7.75 billion yesterday. That is the most since January 11th, certainly that was the most before yesterday's record, and that was the first day that the funds began trading overall. The ETFs themselves reflect the price action in Bitcoin, so it's not clear what's driving what. But right now, we know that they're driving each other, and it's a virtuous cycle. Mike Novogratz told Sonali Basak that Bitcoin may see some consolidations, even corrections to the mid-$50,000 level before rallying to a record and ending the year, what he says, much higher. Let's move on to the actual movers in today's session. Duolingo jumping as much as 23% on an earnings beat, and the outlook topping analyst estimates thanks to AI reducing costs and also an expansion into math and music, attracting new users. We're also keeping an eye on Pure Storage, up 25% on the day. It's a flash storage company, and investors cheered the guidance of 10% revenue growth. They say the highlight was an 8-figure major deal with a cloud provider. Chemours, which we mentioned earlier on, down 31%. That's a record sell-off to a record low. The chemical company suspended its CEO and CFO, delayed its fourth quarter results for a second time in a month. Analysts are now worried that this might be more than just some kind of slight accounting error. And Snowflake ending the day down about 18%. That is the most biggest decline ever, delivering a disappointing forecast and also the unexpected resignation of its CEO. The company's senior vice president of AI, Romaine, will now take on the top job at Snowflake.
All right. Well, AI is, of course, the talk of the town. And look, if you got the ticker AI, you're golden. The question is, how golden is the company? C3 AI did report results earlier today, and it posted the biggest gain in its stock in the Russell 2000 today after those earnings. The company is signaling strong demand for their new AI-based apps, talking about 18% growth in the quarter and guidance of $82 to $86 million for the most recent quarter here, pretty much in line with the street is expecting. Tom Siebel joining us right now. He is the CEO over at C3 AI. And Tom, this was a good quarter all around. The forecasts also looked good. Still a lot of questions going forward about the sustainability of some of these gains we've seen in that revenue growth.
Hello, Romaine.
Yeah, and how do you sustain that, Tom?
Well, this this transition into this AI market is not an ephemeral event. This is a secular change in application software, and AI is going to permeate everything we do across the enterprise. And so I think we sustain that growth simply by growing into this kind of unprecedented demand for AI software applications that is very real. generates very real savings for these companies, and this is not ephemeral. This might be the largest event we've seen in the history of enterprise application software.
Yeah.
And C3 is a major player in that space.
And there's a question here about how you position around that. With regards to the pricing strategy the C3 AI takes, you guys have been shifting to that more consumption-based pricing strategy. I know there's always going to be hiccups as you make a transition from one strategy to the next here, but how far along are you in that, and what's been the response that you've gotten from customers?
I think the transition to consumption-based pricing has been smooth. It's been exactly as predicted, and we're well into it. The bottom line is we're here to meet the needs of the customer. And if the customer wants to buy on consumption-based pricing, we're happy to engage in an arrangement that way. However, if they want to buy on subscription-based pricing and make a multi-year commitment, as many of our customers do, we're happy to do that also. So, we're pricing our products structurally however the customers want them.
You rely on the government, the public sector, for a lot of your revenue. Are they among the ones who are requesting or demanding a consumption-based pricing model?
Well, typically, it depends. State and local government, we see consumption-based pricing models. When we get into the federal government, they tend to license year to year because they have 12 months budget cycles. So we haven't historically relied on government as a major sector of our business, but I'd say in the last couple of years, public sector has been extremely rapidly growing. I think federal government has increased, 100% year over year. State and local government might have increased more than that.
So you could say that the change in pricing reflects, as you mentioned, the demands of the customers, which is also changing as well. C3 just announced a new CFO last night. This would be at least the 10th person to hold the role, I believe, since 2015. And it does raise some questions among investors. Why is there so much turnover in this role?
I'm not really certain that's accurate. There's a 10th person since 2015. Our current CFO has been here for the last 3 years, Juho Parkkinen, incredibly talented guy, made a huge contribution to the company. He stays with the company. He continues as VP of Finance. And our Chief Accounting Officer, who is a very experienced partner out of E&Y, assumes the role of CFO. So we're in a position to continue to run a highly efficient finance and accounting organization and deliver pristine financial statements. So it's all good.
Is the management of this company right now, Tom, your vision for this company and whatever help you get from your deputies there, to stay a standalone company? Have you been approached at all by any other bigger firms?
Well, we actually, in the past, we have been approached, but, we have an incredibly strong management team. We have an unbelievably strong group of human capital with a, very, very hard work ethic. And we're running this business as a standalone business. It's our goal to establish and maintain a market leadership position in enterprise application software globally. And I think there's some probability we might achieve that mission.
All right. Tom Siebel, really appreciate your joining us. He is, of course, CEO of C3 AI, and the ticker of the company is simply AI. Still ahead on the close, we've got more on artificial intelligence. We're going to talk to SoundHound AI CEO Keyvan Mohajer about his company's outlook for the year and, of course, the game-changing announcement by NVIDIA that it has a stake in SoundHound. This is The Close on Bloomberg.
We want to go back to that breaking news on regional bank New York Community Bank, now saying that the company has identified material weaknesses in its internal controls. A stock phrase, of course, that typically means that this company has to go back through its accounting, back through its final numbers to find out what's going on. The company not exactly saying what the issue is, but they are saying that they have identified material weaknesses in its internal controls and has discussed the matter with its auditors over at KPMG. We had just reported just a few minutes ago here that the CEO, the longtime CEO of New York Community Bank Corp, would step down. Alessandro Danello, who is the chairman, will step into the CEO role. But for now here, they need to look into those material weaknesses, a delay, Scarlett, in that tenure. 10K filing.
Yeah, some more negative news for NYCB. I also want to tell you about what's going on with Fisker, the EV maker. It says it is cutting its workforce by about 15% and expects substantial doubt as a going concern. This, as the company reported a loss in the fourth quarter of $1.23 a share and said it reported revenue of $200 million. Analysts were looking for $272 million. It sees CapEx for 2024 at 60 to 80 million when analysts were looking for 246 million. So quite the drop off there. You could see the stock plunging about 24% in after hours trading.
All right, another stock that's on the move is SoundHound AI, down about 11% after reporting their most recent results. On the top line, it was actually pretty good. Fourth quarter revenue coming in at about $17 million. That's an 80% jump from just a year ago. The company, of course, still dealing with costs, trying to get those under control and provide a path to profitability for investors. Pleased to say right now that the CEO and co-founder of SoundHound AI joins us right now, Keyvan Mohajer, joining us to talk a little bit more about these results. And Keyvan, thanks for coming back to the program. I do want to start off first with the revenue growth. I mean, 80% is phenomenal. Where did that 80% growth come from?
Well, thank you for having me back. Yeah, this was our record quarter in our 20-year history. It was a great quarter. The growth was 80% year over year. We had guided over 16 million. We are over 17 million. And we're just getting started. We're signing up new customers in automotive, IoT, in customer service. And we had a notable contribution in revenue from an AI chip maker that has been a partner and a friend for a number of years, and this was the first time we had actually revenue.
When you say AI chip maker partner, who are we talking about, NVIDIA?
Well, there are a number of names that we cannot disclose because of the timing. We couldn't clear names, but there was an AI chip maker that generated revenue for us in Q4. There was a very large automaker that signed up until 2037. That's a very long term. It shows a lot of trust and commitment. We won a US-based EV company. And we are in 10,000 merchant locations.
So I'm glad that Romain asked about NVIDIA because, of course, NVIDIA released its 13F filing earlier this month on February 14th, in which it disclosed a stake, and your stock took off. What's life been like since February 14th for you? What kinds of cold calls, cold emails are you getting?
Well, you know, we think we are getting the attention that we deserve. I always tell my colleagues, you have to do 1,000 things right. You don't know which one is going to bring the attention, when the attention comes. You need to have the 1,000 things right. So people look at your story, they say, wow, this is an amazing company. The story makes sense, and they want to buy into it. And that's exactly what's happening to us.
What is your timeline, Keyvan, to turn profitable?
We actually are guiding that our growth will even accelerate in 2025. We will surpass $100 million in revenue, and that will be the year we will be adjusted EBITDA positive for the whole year.
What's the momentum now, though, Keyvan? I mean, I think everybody has seen, at least the major players in this AI space, have seen these massive bumps in their revenue growth, to a certain extent, improvements in profitability. In your case, it's definitely an improvement on the bottom line, though still a loss. But when we talk about those orders coming in now, is there any sense here that we're going to see a material, a commensurate size in orders going forward deeper into 2024?
You know, we've never seen it this good, and we have a very good problem. We have the customer demand is going through the roof. We have international customers with tens of thousands of locations begging us to prioritize their products, and we have to put them on hold to take care of someone who's a little bit bigger. It's a short-term problem. We're going to fix it, but it's a great position to be in. We have more demand that we can handle because of
more demand than you can handle, and that's something NVIDIA has said as well. You've never seen it this good. What does hiring look like for you, Keyvan? Are you hiring aggressively right now? Do you not have enough staff? How much do you need to staff up by?
We are very in a good position. Our staff is in a good position. Again, we've been investing for 20 years in AI infrastructure and technology. We think we are well positioned to meet the demand. We just bought a company. They come with a lot of great talent and engineers and technology. We're incorporating that. And a lot of our big tech and peers are doing layoffs, and we would love to hire that talent.
All right. Great to have you here once again, Keyvan Mohajer, the co-founder and CEO of SoundHound AI. Those earnings crossing the wire right now. And some other breaking news as well. The longtime CEO of Vanguard going to retire at the end of the year. A press release now crossing the wire saying the chairman and CEO, Tim Buckley, will retire by the end of 2024. They have not named a permanent replacement yet, but they did say the chief investment officer and friend of the show here, Greg Davis, has been appointed to the additional role of president of the firm. That's effective immediately. Of course, Tim Buckley has really guided this company now for more than a decade. Of course, one of the biggest financial managers out there. We'll get you some more details here on Tim Buckley's departure. And when we come back after the break, a deeper dive into that inflation report that we got a little bit earlier this morning and whether it changes the calculus for the Fed. Phoebe White joining us over at JP Morgan. Stick with us. This is The Close on Bloomberg. All right, there are inflation reports, and then there's the Fed's preferred inflation report, the PCE print that came out this morning, and it did show that underlying inflation continues to rise, rising at the fastest pace in almost a year. Now, Bloomberg's David Weston had a chance to sit down with San Francisco Fed President Mary Daly, who actually said that PCE doesn't tell the full story.
There are multiple inflation indicators, and you can unpack all of them into what's driving them. But we can't just look at those published inflation data to see the story. We have to actually go into communities and look at what's happening with local house price appreciation, what's happening with rental price appreciation. And there you do see the elements of the slowing you would expect to see. So I actually am growing more confident that housing inflation, shelter inflation, rental inflation are coming down. The speed at which they come down is still unknown, but I'm not seeing signs that they're picking back up yet. And I think that was the big worry, that not only would housing inflation be overstated, but that actually it's a harbinger of reacceleration. And I just haven't seen that in the data up for the localities yet. I mean, housing still remains out of balance. There's more demand than we have supply, and that will take a while to resolve, but I don't see that happening. So when you asked about the levels, I think the important point for people to understand is we don't just look at the level, we look at the patterns. What's the dynamic? What's happening relative to what happened last year to really understand where inflation's heading.
And that was San Francisco Fed President Mary Daly here at Bloomberg headquarters earlier today for a sit-down with David Weston. Joining us right now is Phoebe White, Executive Director and Head of U.S. Inflation Strategy at JP Morgan. And Phoebe, they kept telling me for months, years now, that the PCE report was the most important and most consequential report for the Fed. But Mary Daly taking a much more bottom-up approach to her view of the inflation landscape. Does she make sense to you?
Yeah, I think those comments made a lot of sense, and I think that's what we've had to do in recent months, right? There's been so much volatility and noise to sift through that we have to try to understand what is the underlying trend. The January core PCE jump was a firm number for sure, but we also saw that come after some very weak readings late last year. So I think you have to smooth through that a little bit. I think the January number doesn't derail our view here that inflation is gradually moving lower.
And that gets to the question, too, because there was all this talk in the newsroom this morning about, okay, yeah, fastest in a year, but it was kind of in line with what everybody expected. So kind of cancels each other out. And as Alex Steele will say, that makes it a nothing burger. For the Fed, though, when they go and sort of look at this report, when they head into that meeting next month here, what does that do to that conversation, if at all? Is it basically the same conversation they had at the end of January, or does this change it in any way?
Well, so I think, it came in line with expectations that had already shifted higher after getting the CPI and PPI data earlier this month. So, even though PCE is the one that the Fed looks at, it comes after some of these earlier data prints, right? So does it shift the conversation? I think it reinforces the message here that they want to be a little bit patient, get a few more months of data, and feel confident that inflation is moving sustainably closer to 2%. So our call has been that first cut would come in June. I think that's still likely to be the case. I think it's the inflation data, but then also what's happening with growth and labor markets. We think we'll see signs of softening on those fronts as well. And if that's the case, and core PCE inflation, especially on a 12-month basis, is shifting lower, then we think they'll be in a place to cut later this year.
Okay, so that first rate cut would likely come in June is your forecast. At the same time, you are expecting 5 rate cuts for 2024. Can you walk us through how that's going to materialize?
Right. So again, we think that even by April, that 12-month core PCE rate will be below 2.5%. Again, if we get that with growth stepping down, even if it doesn't, kind of fall out of bed here, we think that GDP growth will step down closer to about a 2.25% pace in the first quarter, and step down closer to trend or below trend as we move towards the middle of the year. We also think that payroll growth will be moving lower. So again, as Mary Daly was saying, and others on the Fed, have spoken about, they will extrapolate those trends forward. They want to sort of manage risks here. And if they're feeling like inflation is much closer to target, they'll want to dial back that level of restriction. I think what will be interesting coming out of that March meeting is the summary of economic projections, especially that longer run dot and how they're thinking about the neutral rate of policy. But even if it shifts up a little bit, we're still well above neutral right now. So I think the case is they can continue to sort of dial back that level of restriction, even if they don't get all the way back to neutral.
So in dialing back that level of restriction, what are you anticipating when it comes to the unwinding of quantitative tightening? Is it too early to start thinking about positioning for that?
So I think that, the Fed has made clear that they want to think about balance sheet policy and rate policy sort of on separate tracks here. The latest we have learned from the minutes and from Lori Logan's comments is that, I think they're still a little bit patient on that front, but we think that we'll learn more at the next meeting, and we think they can start to sort of taper the pace of balance sheet runoff, probably beginning in July. But kind of beyond then, we think that QT actually can continue through the course of the year.
What's the market positioning around, Phoebe, or at least what do you think it should be positioning around? We've had some guests on this program just this week and last who've really talked about this idea that they felt safer extending duration, and more importantly, they actually felt safer just locking in things for a much longer period of time, which I guess is kind of the same thing.
Yeah, I think positioning has been interesting to start the year and can partially explain some of the volatility we've seen in rates markets. I think, positioning got quite a bit long at the start of the year as people were kind of anticipating that we were getting closer to that first rate cut, and then we get the stronger data. And I think some of those positions were washed out. We have a weekly Treasury client survey that indicates actually 81% of respondents sitting on the sidelines on duration right now, sitting in very neutral. So that's part of our thesis here. We think that, if we get some confirmation that things still are gradually moving lower, we will see people reinitiate those duration longs, and that can help push yields lower. So we think now is a good time to get into duration.
All right, Phoebe White, really appreciate your joining us. Phoebe White with JP Morgan on this morning's core PCE report and what lies ahead for the Federal Reserve. And of course, that conversation is driving the markets, or you would have thought it would have driven the markets, but the core PCE kind of was received in a ho-hum manner. You had the S&P 500 down for most of the trading day before closing up higher. And by the way, this is a new record high here, up 0.5% at 5,096. The Russell 2000 outperforming on the day, up 0.7%. Not much movement in the Treasury market with the PCE data matching economist estimates, but Bitcoin Romaine continues to power higher even as its gains have moderated a bit.
Is that fundamental?
Oh, we could devote hours to that debate. This is The Close on Bloomberg.
Back to that breaking news on Vanguard. The chairman and CEO, Tim Buckley, going to retire at the end of the year. He rose to the CEO ranks back in 2018, started his career as Vanguard as a research assistant for the late, great John Bogle. Joining us right now is Eric Balchunas over at Bloomberg Intelligence. And Eric, did this actually shock you? I mean, he's been there not that long. I mean, it's been about 6 years?
Yeah, the other CEOs they've had are, about the same time frame. So I guess it's not that shocking, but I'll be honest, I was shocked. Vanguard is on a roll. I know sometimes they don't get attention because we're just so used to them taking in money. But this year, for example, they've taken in over half of all the ETF flows. So even though all the attention's on stuff like Bitcoin right now, Vanguard just hauls in cash. And so they're doing great. So it's possible he found something else. We don't know. You could probably a lot of people who work at Vanguard could probably leave and make more money elsewhere, like in a traditional Wall Street job. So that's possible. Don't know the details yet, but like I said, kind of a shocker.
Well, they haven't actually said who the permanent CEO is going to be, though I did think it was interesting. The CIO over there, Greg Davis, has now been promoted immediately to the additional role of president here. Of course, he is responsible for really overseeing a lot of the ETF distributions over there at Vanguard. You're familiar with them, Eric?
Yeah, if I had to say that somebody who is the second sort of face of Vanguard, it's him. So if they said he was the CEO, I wouldn't have been that surprised. So maybe he'll be president for this interim year, and then the board will just be like, let's just use Greg. It's interesting. Greg, I believe, was never an assistant for Bogle. So every CEO has been an assistant for Bogle. And obviously Bogle is gone, and that is going to obviously phase out. But Greg would be, if he was the CEO, be the first non-Bogle assistant. But certainly our big theme of Vanguard is it's still got Bogle's DNA, but it's definitely moving into some different places like the advisory world, internationally, private equity, smart beta, quant. These are things Bogle would never have done. And I think Buckley and the CEOs that come after will probably evolve Vanguard in different ways as well.
Yeah, Vanguard says it's started a comprehensive process to select a new CEO, a formal process that will consider both internal and external candidates. It remains to be seen whether Greg Davis could be a candidate for that. Who would you keep your eye on, Eric, within Vanguard as kind of the next generation of potential leaders?
I mean, honestly, Greg Davis would be the first person that I thought of. But, you know, when I visit Vanguard for client visits and whatnot, everyone there is really on the same page. They're very much they've all, kind of have the Kool-Aid going on. And I think that, Vanguard is really a well-run company. I think, that everybody knows what the mission is, right? So I don't know how, the CEO's job is going to be to direct vision going forward. And Vanguard, I think one of their things is restraint. Like, where do they not go versus because they can go anywhere, right? They take in so much money. One of the recent issues was banning the Bitcoin ETFs. Would the new CEO potentially be more liberal on a front like that? Unclear. But I think for the most part, Greg Davis would be the first name that I would say to you if you asked me that.
All right, Eric Balchunas of Bloomberg Intelligence. Thank you so much. And of course, he's written a book about Vanguard and Jack Bogle. You should check it out. In the meantime, we have more retail earnings rolling in next week. You have Nordstrom and Ross Stores, some of the big names on deck. So we wanted to bring in an expert to give us a closer look at the strength of the retailers. She is Dana Telsey, founder and CEO of Telsey Advisory Group. So Dana, the holiday shopping season, we're going to get some final numbers related to that, but going forward for 2024, it's really going to be a question of execution versus strategy. Of the different kinds of retailers, who's going to impress investors when it comes to strategy?
What we're seeing in terms of strategy, you're exactly right, because 2023 was the year of Abercrombie, where their strategy shifted to bring in a new customer to the Abercrombie brand. We're going to need to see the department stores improve their strategies, and you certainly heard about it this week when Tony Spring, the elevated CEO of Macy's, announced his bold new chapter. Store closings, private label enhancements, and product and marketing enhancements are all part of it. But I think every retailer today always is working to fine-tune and update their strategies. We heard about it this morning. Look at the changes that you heard about. Bath & Body Works overall got good reception to some of their new product categories. And now it's that state of the consumer. Can that innovation drive demand and foot traffic? I think we're in a pivotal time for retail because agility means everything in being able to navigate in this environment.
Agility means everything, but then you look at what's happening on social media like TikTok and how quickly the fashion trends come and go. Are the retailers able to keep pace with that at least?
Some of the retailers can keep pace with that fast changes that are going on. You look at companies like Steve Madden, who chase into demand, have a fast-turning strategy. They're able to react very quickly. You're looking at others where, frankly, Lululemon, and you're thinking about the new product fabrications that they're introducing. They're in demand and they're reacting. Loyalty programs enhance that. With around 13 million members at Lululemon, look at what Bath & Body Works just talked about today, a total of around 37 million loyalty members. And why did Ulta partner with Target? because you have over 70 million loyalty members. It's part of the difference.
I am curious as to how much deeper they can go with this. I remember when these programs started to become popular and and then you have the extreme of that, like RH or something that just built a gated community effectively. But I mean, how much more runway does that have? There's a certain amount of people that will do that, and then there's people like me that kind of bristle at it because I'm just contrarian on anything at this point. So
one of the things when you think of who's using social media, and granted, it captures all age groups, but when you're thinking about Gen Z and millennials, you put something on there and it goes viral, and all of a sudden you have global awareness and reach. Then they become a member of that loyalty program. And it's all about brand has to say what it does and do what it says, and then you create adoption. Look at companies like Deckers. It's going to be very exciting. Beyond UGG and Hoka, they're coming out with a new brand, supposedly a cross between Veja sneakers and Golden Goose. Opening price point of $225. Anxious to see what it is. So 2024, innovation and value are the keys.
I am curious, though, when we talk about innovation and value, it's one thing to talk about a Lululemon or the Uggs, or Deckers, I should say, companies that basically make their own products and then sell them through their own channels or through third parties. Where does that leave, though, a department store like a Macy's or a Nordstrom's or a Ross Stores?
Trying to become more differentiated.
Yeah.
Ross Stores is more in the off-price category, so value drives demand. When you think about a Macy's and you think about the Nordstroms of the world, each of them now have off-price areas, whether it's backstage for Macy's, Nordstrom Rack, but the full-line department store, they're trying to create excitement, reinvesting in the full-line stores, putting out personalized emails about what may be appealing to them, and frankly, attracting people through events. Events matter.
Events matter. I'm curious, what did you think, though, about Tony Spring's bold new chapter? Because he made it clear that he was going to lean deeper into luxury, put a lot more focus on Bloomingdale's, which I guess shouldn't be a surprise given his background. But do you think that's going to be the right strategy?
I think it helps. I think certainly we haven't seen the sales growth given what they've done. And frankly, the closing of the 150 stores, it always has been said that around 150 of the full-line Macy's stores drive nearly 50% of the sales. So you don't need 500 doors, but you need productive doors of what you do have.
All right. Dana Telsey, thank you so much for giving us a deeper look into the retail sector. Dana Telsey of Telsey Advisory Group really giving us a read into the different retailers and their different strategies. We want to shift gears now to the business of sports. College basketball star Caitlin Clark, she is driving ticket prices to record highs. Fans, they're hoping to see her break Pete Maverich's NCAA Div 1 scoring record during this Sunday's game. So, of course, we had to bring in Bloomberg's Jason Kelly. He is Bloomberg Original's chief correspondent. She is an economic force unto herself that is remaking women's sports, isn't she?
It's unbelievable to watch, and it's one of these things that was happening slowly and then all of a sudden when it comes to the popularity of women's basketball and the popularity of certain stars in the game, for sure. You cannot underestimate the power of the name, image, and likeness money that is coming in. She is one of the most heavily endorsed athletes across the board, certainly in college. And at the end of the day, she's also an incredible player. She's so much fun to watch. I mean, when she broke the women's scoring record, she did it with one of her patented logo threes, and people just go nuts. They love cheering for her. And
they love jeering her too, which is also part of it.
They do, and she loves being jeered. I mean, and she's like there for it.
Because I only like her for the trash talk. She reminds me of like when Jordan, whenever.
Oh yeah,
Because
she's like, bring it, and because she knows she's going to deliver. She is very Jordan-esque. I love that comparison.
She is, definitely. I am curious, though, about your show. You didn't get a chance to interview Caitlin Clark, but you did see some other well-established athletes out there, including Maria Sharapova here. But you weren't just talking to her about, her backhand or anything.
Right. Yeah. I mean, so this is a show called The Deal that Alex Rodriguez and I sort of conceived of and are now hosting for Bloomberg. Maria Sharapova, as you mentioned, is episode 1, which premiered today. And this is all about largely what's happened off the court, off the field, off the pitch, and big decisions that athletes have made and sort of putting together their business playbook.
Yeah, kind of like Alex Rodriguez's own journey from player to businessman and investor. Let's actually take a listen to what Maria Sharapova told you and Alex.
I mean, one of the things that I feel like you're spending more and more time thinking about, too, is this notion of, and certainly this is something that will resonate with you, Alex, this notion of high performance, this notion of like working under pressure. I mean, I'm sitting in between two people who
Who loves pressure?
Who love pressure. I mean, who beyond
Yeah.
thrive on it.
Yeah.
How do you translate that though into a life that doesn't have such clear winning and losing on a minute to minute basis?
Well, it's acceptance that it's not always going to go well. No matter, you might have the best intentions, you might have the strongest preparation, the strongest mindset, the best team. I always say you have to be realistic. You can be confident, you can be underplaying your results, but you still have to go out and show up. And sometimes things are out of your control. People say certain things, you don't like it, go home, do your job, keep working, you'll get the results. So acceptance is one of them. Work ethic. Work ethic from a young age, understanding that nothing comes easy. We both come from humble backgrounds, and when you know what that feels like, I'm not a big spender. I know what's in my bank. We go as star athletes, we go through these moments of, fame and spending, and you kind of lose track of what you have. I thankfully didn't go in that direction. I was very, had a purpose in how I spent, what I spent. I counted little coins when I was young, and I would still count them if now we have to do those cyber coins.
I love the candor there. By the way, you can catch that full conversation with Maria Sharapova tonight on The Deal. That is the premiere episode of this series. Jason, it's not just Maria Sharapova. You talked with a number of prominent athletes turned investors, businessmen. Mm-hmm. Which one are you looking forward to sharing with us the most?
So I will say two. One is next week, Michael Strahan, legendary football player turned broadcaster, media personality, morning host, all of those things. He was everything I wanted him to be, just this larger-than-life personality. Seeing him and Alex talk about playing in New York was just an amazing experience, and sort of what that meant to them, but also what winning in New York entailed. And then, really circling on the calendar, Derek Jeter coming up in episode 4, having Alex and Derek sit down in a way that they almost have never done and really talk to each other about their own experiences as players, but also as businessmen. And, that's a friendship, a relationship that's lasted 30 years. So
as
it's pretty
colleagues,
amazing.
too, former colleagues.
Absolutely.
Yeah, how much insight do they give you really into kind of what really went on behind the scenes, and because that's what everyone really wants to know, right?
Quite a bit. I have to say. There were some real moments of candor, and I don't want to spoil too much, but some observations that each of them made, Alex especially, about some of the things that went on between them, but also what it felt like to be in those just catalytic moments for both of them, and stories they tell about being younger and the aspirations that they had, and what they would have done to just keep playing baseball from a young age, which both of them were able to do.
Going back to your partner in crime, Alex Rodriguez, what is he up to these days? I know that he's had and has lots of conversations with Warren Buffett. He's also a owner of the Minnesota Timberwolves, but he's kind of got his fingers in a lot of different pies.
He does. I think he would identify himself as an entrepreneur and an investor, just the way Maria Sharapova does. I do think he is spending a lot of time in this role as a team owner. So, the Minnesota Timberwolves and the Lynx in the WNBA, he and Mark Lowry are in the process of buying, full control of those teams, and that transition from player to owner has been done very, very few times. Magic Johnson has done it. Michael Jordan has done it. That's pretty good company to be in. And I think, again, applying what he learned as a player to being on the other side of the table is going to be fascinating to watch.
All right, Jason Kelly there, and you can watch The Deal with Jason and Alex Rodriguez every Friday at 7 p.m. Eastern Time on Bloomberg Television, or wherever you stream Bloomberg, on Thursdays at 9 p.m. Eastern Time on Bloomberg Originals. All right, we do want to get to some breaking news here. This on Mattel, shares down 4%, a delay in its 10K filing, finding some deficiencies here in controls over its financial reporting. The company says that it doesn't see any material misstatements or omissions, but enough there that it has to delay the 10K here and look a little bit deeper into exactly what went on. Those shares down 3.5% here as we push ahead to the next 24 hours and what investors are going to have their eye on. And we're going to start not in the U.S., Scarlett, but over in the European Union.
Yeah, European inflation numbers come out at 5 a.m. Eastern time. Critical, of course, for the ECB because they are a single mandate central bank. It's not like the Fed where they consider full employment as well. So that's going to be a big, big question mark for the EU. Year over year, we saw that the February CPI grew 3.2%. And for harmonized for February, we're looking for a 1.1% month-over-month increase.
Yeah, well, so, and then back here in the U.S., we're going to get some more economic data. Of course, we're going to get that final update on the Michigan sentiment numbers, but we're also going to get some manufacturing data as well.
Yeah, ISM manufacturing comes out, and it's hovering right below 50, which indicates that the manufacturing sector is shrinking. 49.5 is the expected read that we're going to get. But we want to pay attention to prices paid because that's another way of looking at inflation, just how much companies and manufacturers are paying for their supplies, and that's expected to tick somewhat higher.
We've gotten a lot of Fed speak this week, and, well, we're going to get some more tomorrow, including from some of the same familiar faces. We had a sit down with Mary Daly today, but she's going to speak tomorrow, as is Raphael Bostic.
Your favorite Fed official.
Yeah.
Right?
Yeah, absolutely. And in addition to that, well, we get more primaries. I don't know, Scarlett, if you weren't into Michigan, are you going to be into Washington, D.C.? It's not even a state.
Yeah, that's what I was wondering about, right? Washington, D.C. holding a Republican primary. Does that move the needle in any way?
Well, no, considering I think, what is it, like 80% Democrats in terms of registered Democrats.
Also, nothing's moving the needle right now,
city.
right? We already know what the race is going to be.
But no, anyway, maybe it's just another stair step here on the path to the nomination for Donald Trump. Stick around. In fact, if you are interested in that, well, you're going to get a whole hour of it coming up next. The Balance of Power team is on deck. Meanwhile, we'll be back tomorrow here with full markets coverage right here on The Close, right here on Bloomberg.